People want to take pride in where they live. People want to have dignified living spaces. Now, I've done real estate investing in all levels of the market, meaning working class income to luxury living. And the need for dignified, prideful living goes across the board. So if you take that attitude and you go into an area and create value with a prideful intent, then what happens is that value will transfer to the resale, the refi, the repositioning of that property.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 303. Today, we're going to check in on the current real estate investment climate and how you should consider positioning yourself and your business to deploy funds and grow your portfolio. And here to have that conversation with me is Yusef Alexander. He's a real estate industry thought leader with more than 20 years of working class real estate industry experience. Yusef serves as the Vice President and Chief Business Development Officer at Real Estate Asset Partners, and he's involved in acquisitions, property management, leasing operations, and sales and marketing. Yusef, welcome to the show.
Thanks for having me, Brian.
Why don't you tell us a little bit about yourself and how you became a real estate investor?
Born and raised in Los Angeles, went to UCLA, economics major there, started to teach math and science as an early UCLA grad, and at the same time was being mentored or kind of instructed by a gentleman that knew how to buy and sell property in marginal areas in the city. And I just took a hold to that and just had a feverish attitude about learning and grew an operation that spanned over maybe 8 to 10 years, buying and selling, repositioning properties in the Los Angeles area. Then I took my experience to different states, Arizona, Chicago, and then finally to the Southeast. But as I took my experience to different states, I started to scale the level of the operation. So it wouldn't be 1 to 4 units, it'd be 10 to 20 units. And then it kind of grew from there, 50 unit buildings. And now, I'm involved in some projects that are 100, 200 unit building projects. The frequency of those projects, buying and selling them or buying and refinancing them or buying and holding them aren't the same, but the fundamentals that I've learned over the last it's almost been 27 years I've been doing this. The fundamentals have remained the same. So that's kind of my career path. I feel like it's just a new beginning because of all the things that have happened in the market and in our society. There's a lot to dig into there. And it sounds like you've created a system for just buying residential rental property. It sounds like you started with single family and now you've moved up to multifamily and larger apartment communities, and you've just been doing it and growing in scale. But let's go back to the beginning, because I used to live in Los Angeles too. I'm sure probably right around the time you got started, I was probably living there, and I wanted to start investing in Los Angeles, but everything was so expensive. So tell me a little bit about your mentor who showed you the way to do it and kind of how you first got your feet wet buying rental property. It was kind of the perfect storm, if I should say, Brian, because, we're coming out of a recession in the mid 90s. And like you said, there was a lot of expensive property around the Los Angeles area. I was coming out of school as well. And we're also, the other part of the storm was we were kind of piecing society back together after the earthquake in the early 90s. So, and this earthquake actually affected, the kind of vein of the city, which was the I-10 freeway. And that freeway actually collapsed. So imagine all of the things surrounding that, that collapse and the rebuild. And we were just coming out of that. So the earthquake and me coming out of school and the recession timing and the market timing was just kind of perfect for me to start investing. And basically what I did was I went to neglected areas. I went to areas where, it's the marginalization of the communities that, the values were very, very, very much affected when market changed. And since those values were affected, I knew, or I found out, I shouldn't say I knew, I can look Monday morning quarterback now, but when I was in it, there was value to be added to those areas and those assets. And I had to learn how to do it. And that's what my mentor taught me. He taught me how to do it.
So it's interesting because that exact same time period when the earthquake hit, I moved out 2 months later. I moved to Los Angeles 2 months after the big earthquake hit. And the other factor you didn't mention was the aerospace industry had kind of imploded at that time. So there was a lot of distress in the market. And had I had any net worth or wherewithal and understanding of real estate investing, that would have been a great time to buy, because you're right. That was, everything kind of was at its lowest point right around the mid 90s.
I have this nostalgic piece of property that I could have sold it many times over. And it's not, some home run, but I bought it during the mid 90s. And I still have it today because it reminds me of just what you said, all of the things that were going on. And it just was it firsthand. It was an interesting place to be in all parts of the United States, but especially, in Los Angeles, ground central after that earthquake and those things. So fresh out of college, green around the ears, just not knowing a lot, but just ambitious and curious. Took me on a path of this real estate investing career. And I'm thankful and grateful and I'm still cranking away.
So talk about that strategy early on and the mentor and what he taught you. And maybe you can weave in the nostalgic property that you bought back during that period and kind of use that as an example of the type of strategy you were employing.
The strategy was this: understanding that people want to take pride in where they live. People want to have dignified living spaces. Now, I've done real estate investing in all levels of the market, meaning working class income to luxury living. And the need for dignified, prideful living goes across the board. So if you take that attitude and you go into an area and create value with a prideful intent, then what happens is that value will transfer to the resale, the refi, the repositioning of that property. And I went in those areas with that intent. And one of the reasons is because I grew up in those areas. So I remember wanting to live in an updated living environment, a living environment where I felt connected to the economy, the marketplace, the surrounding areas. And, I didn't know that I would hone that craft and hone that skill over, 2.5 decades and still, I have that skill today. Yeah, I was learning how to bring that prideful and dignified living to those areas. And it works. The track record shows. So that's the strategy.
How does that play out in real life? Does that mean putting a certain amount in per door, putting luxury vinyl tile on the floor?
I used to, and I don't even like this term now. When people say, "Oh yeah, I'm going to go somewhere and do some paint and carpet," that was one of the terms that people would throw around in the industry, 20 years ago. Hey, just paint carpet. This is one of those type of rehabs. No. What it is why doesn't it reflect what the community needs? Maybe the community needs, more bedrooms, an open living plan. Maybe it needs larger windows. Maybe there's traditional colors and combinations to 1950 homes that those traditions were there, but they brought a certain attitude. So you take the traditions and you try to save as much as you can, but you also try to update living spaces, aesthetics. And by the way, the increased cost to doing more high-end amenities is so small. Maybe 2%. I don't know. I would have to look and go do some analytics about it. But basically, yeah. So you're doing amenities, you're doing fixtures, you're doing updated living spaces. Every room needs to be connected. You got one plug in rooms in the 1950s because there were no appliances. Now everybody has devices. So why don't you update the electronic setup the way that a family would live today? This is how you do it. as you take that attitude and put that attitude into a space for prideful living with the intention of prideful living, the value will be there.
So it sounds like you were doing some full-on rehabs then. So this strategy was by a single family at the time?
Single family, 1 to 4 units at the time. These areas were very, very, very neglected. I'm talking South Central Los Angeles and all the surrounding areas.
At the time, those weren't just kind of marginalized or neglected areas. A lot of the perception was those were dangerous areas too.
Absolutely.
How did you navigate that? Did you ever have any real problems trying to deploy the strategy in some of these neighborhoods?
Absolutely. And what I did was I rolled my sleeves up and our team and created a team, and the problems became challenges. So if there was a security problem, then that was a challenge and you solved the security problem. If there was a materials challenge, you solved the materials challenge. If there was an operational challenge, meaning the type of talent that you need to rehab these type of places, then you solve that challenge. I mean, it's just as if you were running a singular company or a multinational company. It's like, these are challenges.
What were some of the specific challenges then that you were facing? And what were some of the specific strategies you employed to get past those challenges?
Something that comes to mind would be materials issues. Let's just say you had, materials on site at a job site, and, $20,000, $50,000 worth of materials, however much it was. And then you go there one day and the materials aren't there. So what you need to do is what we needed to do is solve that challenge, meaning scheduling of the materials, and the materials needed to be scheduled in some protocol way where they were managed when they landed at a job site, and they were also secured. So one of the things that we did was I had a asset manager type of role that would be on site to secure all of the materials in one place. So sometimes my garage would become like Fort Knox. So you have Fort Knox in the garage, and then you had a kind of I wouldn't say a carcass, but you'd have a demo site in front of, which would be the living space and everything you needed to do to secure those materials. So you had the scheduling, the personnel, and the secure location. And, in any challenge that would come up, that's how you would deal with it. You would deal with it as a challenge and as have the intent to solve it. So, yeah. And some people, a challenge is the impediment for them to continue. And some people, the challenge is an opportunity to create a protocol or a system for them to employ for the next job. And by the way, Brian, let's just be honest. I lost on several deals as I was learning this industry. Things weren't first, you hit a triple on your first deal, and next time you hit a home run, and then you're just kind of high-fiving everybody. No, these were nights and days of a lot of anguish. And sometimes you have those dark thoughts like, is this what I should be doing with my time? And looking back, it was absolutely the right thing to do.
Why was it the right thing to do? And what kept you going if you were, I'd imagine it was losing money on some of your initial investments. What kept you going?
Blind silliness, I mean, because if I were to do some of the things that today, my tolerance for issues and challenges at this point in my life I don't have a big threshold for that. So I just had the ambition and the ignorance to keep going because there was a lot of people that didn't.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
What was the key shift that turned you from an unprofitable real estate investor to a profitable one?
I think it was a mentality, because what I did, and I had the advantage of seeing several people in my industry that were 5-10 years down the road. And I knew that, if I learned this, then it would end up in something stable, as a stable business or a stable career for me to continue to follow. So I knew that. Now, I didn't know if I was going to end up on the other side of that 5 years so scarred and bruised up that I was just, the bitter guy and I needed to figure out another career, or I didn't know whether I was 5 to 10 years and like, wow, thank God, I figured this out. So I didn't know that, but I didn't know how I would be at the end, of the 5 to 10 year plan, but I knew I can get there.
So what was next? You were investing in the 1 to 4 units in marginalized neighborhoods, doing some full-on rehab projects to probably create some product that was of a higher quality than the neighborhood was used to. So am I right in that sense?
Absolutely. Mm-hmm.
Where did you take it from there? Because I know for the past 27 years, you've just been going. What was the next evolution in your real estate trajectory?
Markets change, and all of the things included in markets change, from, politics to interest rates to values. So what I did is, I wrote a nice market trajectory for a while. And then when things kind of changed, I went and looked at multifamily or small multifamily units. So, it just wasn't profitable to do, 5-10 projects a month. And it was a better business strategy to do some scale. And what I did was I looked into apartments, and I couldn't find any that really kind of fit my needs and my criteria in the Southern California area. Although now that I look back, there may have been some. So I went to Arizona, and I found a few, buildings, 10-unit buildings, 22-unit buildings, and went there to start my multifamily acquisitions part of my operation.
So that's an interesting shift. Did you move to Arizona, or did you find a partner there to kind of be your boots on the ground? How exactly did you accommodate that shift?
I did the deal with, a couple partners, but I drove from Los Angeles to Arizona. I drove from Los Angeles. I was living in Los Angeles at the time. So it was I think maybe a 3-hour drive. It was in Bullhead City, Arizona, one of the hottest cities in the United States. So the Colorado River is the geographic boundary between Laughlin and Bullhead City. And that Colorado River goes up north and kind of travels down south.
So moving out of state, because that's kind of what I did too. Living in Los Angeles when I started investing, I couldn't find anything in Los Angeles that I could afford to buy as a rental property. So I started investing out of state too. You actually drove to Arizona then and found a place to invest. Tell us how that worked out for you.
It worked out in the end. I mean, I owned the property for 3 or 4 years. I bought it and I did some rehab on it. I learned, the different elements of that particular asset class, management, the leasing, the added value, and just, having scale. So those things came into play with that smaller asset, that small multifamily that wasn't really, that I needed to learn and I needed to kind of, wrap my arms around in order to be successful in the next, iteration of what was going on. So, those things in the multifamily, in that small multifamily property helped a lot. The market helped me more than my experience.
Yeah, the market was only getting better and better at the time. So Yusef, you had a mentor who had helped you back in the beginning. Was he also helping you with the multifamily, or did you find another mentor or someone to kind of help coach you through that process?
This was out of his wheelhouse, and it just came from, ambition and again, scale You wanted scale, and then the market changed. So now in this next phase, it was pretty much not necessarily self-taught, but I would have to get around folks that were doing the things that I wanted to do. So it wasn't one particular person. It was kind of a medley of things, reading and getting around folks like-minded investors, and driving different places and flying in different states to see, different communities. So yeah, bunch of learning.
So how big did you get your portfolio in Arizona before you moved on to the next level?
We just, had a couple buildings there, and then, we moved on to Chicago, actually, to the Midwest. It was just a small, maybe, a few dozen units in the Arizona area. And then, and then we moved on. We kept going east.
And were you just in search of yield at the time, or opportunity, or what exactly were you looking for?
At the time, I was looking for a place that I was comfortable. Like I didn't have any network or any, kind of conversations or things going on in a place like Minot, North Dakota. So I wouldn't go there. But I had a few, colleagues and peers that did business in Arizona. So that was kind of those whispers were starting to get louder. So that means, and then I would follow those things. And then in Chicago, I actually had some family there. So I would visit back and forth. So I kind of had, knew the different communities. I didn't know him as a real estate investor, but I knew him as just a visitor and kind of a person, just kind of making his way around the city. So then I would go there, and then I would kind of experience the city and try to get all of the intel that I needed, which I would do when on family visits and stuff. And that was kind of a natural move. So it wasn't that I had some crystal ball and I was following, all the good markets and getting all this yield.
It strikes me that the way you describe the process is you had a mentor, you started investing in these neighborhoods, building your portfolio, you moved to Arizona, then you went to Chicago. What was in your way at the time? What were some of the challenges in doing this? Because you make it sound very simple and logical, like this is just what I did. But there's always obstacles and challenges along the way. And I'm just wondering what yours were.
There are challenges in penetrating a new market. Every market has its own nuances and its own kind of personalities. And there's challenges kind of getting, underneath the surface of a community to figure out what are those nuances to be opportunistic and, where to go and what to do. And my experience is you just have that right attitude, because there's a reason not to do anything. So if you give yourself a reason to do it, one of the things I did in Chicago, I bought a place to live. I said, I can't drive back and forth here. So let me plant my flag. I bought a place in a nice area. And it was actually a good, me coming from California at the time, I said, this is a great deal. I don't know anything but opportunity at this time. So I bought a place. And why did I buy that place? Well, I bought the place because I forget, it was a guy on TV. He was like Celebrity Apprentice or something. He was like a bachelor or something. And I saw the guy walking down the street. I said, I'm going to buy something in this area. These are where the swanky people live in Chicago. So, I was maybe late 20s at the time. So there's a gym there. There's the swanky neighborhood, the good coffee houses and stuff. And I found a deal. So now that I bought my place there, plant my flag. Oh, okay. Then I'm going to spend some time. And once I'm spending time in an area, I have the same instincts and experience that I had in another market. And what I started doing is combing the area and beating the bush and making sure that all of the things that I needed to find out before I started to deploy resources here were in place.
The instincts that you had once you moved in there to Chicago and finding those resources and taking those steps, a lot of people just get bogged down in even figuring out, well, what are the steps I need to take? So what are the steps you take when you go into a new market? What are those resources you go looking for?
You want to start building a team, a network. You want to have, bird dog finders on your team. You want to have quality rehab people on your team. You want to have the different offices that'll help you process these transactions. When you just got to get, your marketing out, you got to get out. You're an investor.
Do you open the yellow pages? Do you go to investor networking meetings? I mean, how do you start forming that team? You're fresh to the area. I know you had some family in Chicago.
I'm picking up the phone. I'm a phone guy. Well, 15, 20 years ago, I'm picking up the phone, I'm calling everybody. Hey, how you doing? Yusef Alexander. And here's my criteria that I'm looking for.
You're talking to brokers and real estate agents.
Talking to anybody that has a pulse, that thinks that, that I think that will be an opportunity. I mean, I'm talking to the guy in the coffee house, the barber shop, anybody. And, I'm in town. And if I was a band in town, hey, I'm playing at the, Sabre Theater tonight. I'd say that to my barber if I was a band playing at the Sabre Theater and I was in a different place. Hey, I'm here. Well, you might call, sometimes things lead to things, but that's kind of what my story was.
So you're just creating momentum. You're talking to anybody and everybody, kind of just getting the word out there. How are you creating credibility for yourself at the same time? Because you're new to this market. There's other people who are established players, especially in Chicago. I'd imagine there's those people who kind of control the market. And how do you break into that?
We did some kind of, whiskey tasting type things and some networking things. And, you just, yes, you try to figure out who the players are. And sometimes opportunity comes in all shapes and forms. So it could be from a coveted group that has their hooks in the market, or it could be a turnip falling off the turnip truck, meaning, wow, this kind of fell, let's follow this lead. So yeah, there's no single formula. And unfortunately, I see a lot of people that start real estate investing that want me to give them some insights. They want a formula. They want to say, if I talk to this person and I do this and I say this scripted deal, then I'll be successful. It doesn't work like, unfortunately, for me, for other people, it may.
Well, and instincts play a huge part too, because you have to know when you're wasting your time and other people's times and when you're actually going to get some yield out of your efforts. So I'd imagine you fine-tune that over the past 27 years to get to a point where you realize, okay, I don't want to go down that road because there's nothing at the end of it. This is the road I need to go down. Do you feel that that's true?
I'm going to bring it back to the multifamily discussion. So if I look at 100 properties, 200 properties, and I buy one, that's a 1% success rate or turnover rate. Those 98 properties or 298 or 198 properties were learning experiences for me because I could gather intel. I could reference things that I may have missed on. I know I've missed out on, and I can use that as, future information, analytics, data for me to continue to navigate. Or I can say, oh, I wasted my time on this. I wasted my time on that. No, this is what I'm doing. So however you frame it.
What was next? Chicago, and then you moved into some other markets as well?
Yes, no. So eventually, which was the bulk of my career in multifamily was in the Southeast. Moved to the Carolinas and Georgia, and then syndicated investors and created a portfolio there, and since have completed that part of my career, meaning the business plans of those assets. So yes, that's where it moved to.
So where are you now then in your career? I mean, you're sitting in your backyard in Los Angeles. Beautiful background, by the way. You seem to be at a certain place where you have a certain amount of wisdom and experience. How are you deploying that now?
Right now, I am, of course, I'm opportunistic. I have some deals here in Southern California that I'm actively working on. I still have some legacy assets in the Southeast. I'm actually looking at another market, which is, Texas and some kind of surrounding areas to do some deals. But it has to be a fit for me. Fit meaning the property, the asset has to be a fit. The area has to be a fit as far as, my lifestyle. Like I, have interest being there. Capital partner has to be a fit, has to be kind of a, very friendly situation because of, like you said, what I've done. And it just has to be a fit. It just, what I like to do is my intention now is to continue to create abundant exchange, meaning the abundance of the proceeds and profits of the business plan that we execute, and the abundance of added value that we give to a community. And, if things don't line up in that nature, then, it's not a fit for me at times. And that's not the only thing that I look at, but that's those two aspects, the community added value and the returns are something that really, really keep me, on purpose and at my stage in my career and where I am in life. So if those things line up, then I'm very interested. But I'm a deal junkie, Brian. So I look at a lot of stuff.
So what do you like best? Is it chasing the deal and finding the deal, then taking it down? Or is it like once you have it, adding value and creating value for yourself and your investors?
I was actually going to write a paper or like a kind of a blog post on the emotional experience of all of those things you just explained, because there's a bunch of stuff going in the chasing of. I've been excited chasing. I've been, challenged chasing a deal. I've been excited finishing a deal. Had a flat attitude after I'm finished. I'm like, now what we got? It's just there's a, and I still may write about that.
Well, that would be valuable, because I think the emotional experience is kind of underreported, because there is that high you get when you chase a deal. It's kind of like gambling in a way. It's like you feel like, hey, I'm going to go in there. I'm going to get this under contract and do all my due diligence. Obviously, it's not gambling because you do your due diligence to make sure it works, but there's that rush to it. But then, like you say, sometimes then you complete the acquisition and there's that flat feeling like, okay, what's next? But there's also sometimes feelings of despair when things don't go quite right and it looks like everything's going to fall apart. And that's something that you don't hear much about. Do you experience that?
What I tell people when they feel despair on a particular project is you don't have enough activity. There's always opportunity and there's always things that go wrong. So you just have to stack your opportunity, the opportunity side of the ledger more than the things that go wrong side of the ledger, and focus on the things that are going right. One beginning investor said this to me about that particular thing. One deal won't make or break you. If one deal is making or breaking your career, you're either gambling or you're in the wrong business, because that's not how this works.
It's not a race, it's a marathon. You're going to have your ups and downs, that's for sure. So tell us where you are today. Like, where do you see the investment climate today? We're recording this mid-September 2021. I know there's people in two different camps. One is there's a bubble and it's all going to burst and things are going to go backwards. And then there's the roaring 20s people who are like, no, it's just going to keep getting better and better. And the demand is there for housing and it's always going to be there. And it's going to keep people like us going forward and going strong for at least the next 5 to 10 years. Where are you right now?
Where I am now, September 2021, is there's opportunity in the market. But the market, it will change. That's what we do know. That's certain. It will change. Now, values will change. It'll fluctuate. Renter sentiment will change. And the migration of populations, will change. So as you follow those things as an investor, and whatever drivers that are allowing the investor to go after deals, if you follow those things and stay true to them, and buy correctly, then, you can make money in any stage of where the market is going. If the market has, the value has kind of changed and it's, decreased, then of course you do things to accommodate that. But what I find sometimes is investors are looking, beginning investors, not long-term investors. They're looking for a run. They're looking to buy something and not be measured and skillful about their approach, intentional about their approach, and then the market will kind of take care of their mistakes. Yeah, that works in the stock market, and it works in in real estate, works in any kind of participation in this investment space. That's not a long-term plan. So where do I see the market? I see it buying right. I mean, we're still in a pandemic, and we're in a different phase of it, with the vaccines out and different kind of semi-open as we can be, I guess. But those things need to be considered as you move forward. We're in a pretty much as the lowest interest rates that we could possibly be in. There's no more interest rates manipulation that could happen through the Fed. So that needs to be considered. And we're also in a phase where the economy is saying, okay, we value certain things and we don't value certain things. We value where we live. Yeah, but we may not value a lot of, consumable things the way we did 2 years ago. So then jobs and the consumer sentiment may change. So anyway, as you take that into consideration and look at the investment in the market that you're operating in, it should tell you what to do next. And I can even drill it down even further. So you buy an apartment building next to a Walmart or a retail, big box store, and a big box store had 50% employee decrease. Okay, well, those are jobs. That's 50% of the jobs that went away. So that's 50% of the income that went away in the population. That's also 50% of the people that could possibly be your customer went away. So you probably want to take that into consideration versus buying on the upswing.
So Yusef, what advice do you have for our listeners who are looking to get into a market or looking to get started or bring their investing up to the next level like you did many times?
Stay diligent to the things that have brought you past success, meaning they've done something that has kept them afloat business-wise, and they've also done things that created the track record, the beginning track record that they are involved in now, and continue on that path. Because one of the things that I see is when especially entrepreneurs, sometimes our eyeballs are so big that we try to do something else. We'll go from working class to luxury to from single families to apartments. We start doing things that kind of outside of our lane, so to speak. And I've done that, and I advise not to do that. Just kind of stay where you are, stay where you have some base hits and incremental success, and take that knowledge and build on it.
And how would people get a hold of you or find out more about you?
I take personal emails, and so someone can email me at Yusef@reap.capital. And yeah, I'm not the big social media person, but bounce around a little bit with some of the social media. I don't really check it, but my emails is the easiest way to get in contact with me.
Yusef, I want to thank you for joining us on the show. It's been real interesting learning about the past 27 years of your investing trajectory, starting by investing in marginalized communities and then moving outside of Los Angeles to Arizona and then eventually Chicago and then the South. I appreciate the wisdom you've shared about just the challenges and obstacles you've encountered along your way and the ways that you've gotten past those. So thank you so much for having this conversation with us. It's been a pleasure.
Really enjoyed it. Thanks for having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.